What's going on? We are back again. I'm Jared Fausnaught. I'm here with Conor Reilly with Washington Capital Partners. We are on lucky number 7 minicast, lightening the mood today with a fun topic. Just talking about what are some common myths with hard money lending, just that space in general in the lending world. We hear a lot of crazy kind of topics and things that people are saying out in the market about hard money lending. And this is just kind of a fun conversation to dispel some of the myths and the rumors that we get a chuckle about in the industry. So kicking it off, what is probably like one of the biggest things that you hear, Conor, that people say that you're just like SMH, shaking my head, right?
I think the biggest one is that hard money loans are strictly for people that are in tough situations. And you and I both know that to be completely false. We work with people that have excellent credit score, that have done 15 plus deals. These are bankable people. And they still work with hard money lenders all the time. It's not specifically for the individual with a low credit score or no track record. So that's probably the biggest myth that we need to debunk here.
Yeah.
Is just letting everyone know that truly hard money loans for investment purposes really is for everyone.
Yeah, it's for everybody. There's a whole host of different reasons why somebody would get a hard money loan: speed, ease of use. There's so much detail in getting bank loans and all sorts of stuff like that. So we fill a space in the market that's really valuable. And there's plenty of really high level institutional type developers that use hard money, for a lot of reasons. So yeah, absolutely. I mean, that's the biggest thing. People kind of, look down, thumb their nose at the hard money lending space because it's not a bank, right?
I think a lot
kind of
has to,
like backwater lenders.
I think a lot has to do with the previous connotation of hard money lenders.
Exactly.
10 plus years ago,
Great
that
point.
space, that space is really gone. It's much more of a refined space now, especially in our area. We've carved out a big niche of the market. But you were saying earlier how the speed of things and all of that relates to another myth, that hard money loans are more expensive. Now, interest rate and origination charge may be greater compared to a bank loan. However, you have to consider what the time frame is to close with a bank, to receive draws. How fast can you move through the project? A lot of people just look at that as the cost of business. So don't be afraid of hearing 2-3 points or 7 or 8% interest rate, which compared to where we were 3 years ago, we're at
That's
so
low.
low right now.
That's low.
Yeah.
Yeah, I love that. I love that we're down there. And we're always working on trying to get cheaper cost of capital and passing that on to our borrowers. But yeah, I mean, there's a couple of things to unpack that a little bit more. What's the cost of doing a deal with like a relative, or doing, what is an equity raise from partners of yours, right? I mean, you're probably talking about, 50% of the profits, the margin of the project. Maybe not that high, but definitely substantially more than if you were to get a hard money loan. And the costs have come way down. So you're right. It's not as expensive. And people, like, we hear this all the time. That's the number one complaint from banks right now is, even with COVID starting to kind of be on the up and improve, the draws just got destroyed. They were crushed with the banks. And I mean, we're still seeing backups with local banks being a month and a half, 2 months for getting a draw out. I mean,
A lot of that,
I don't even understand how that works functionally. Like, why would it take 2 months to get a
a
draw out?
lot of that is due to because they're requiring like the city
Additional inspections,
and they're
right?
not out there. They're either doing it through Zoom and then it's not getting approved, or people just aren't showing up.
Yeah, yeah. That I heard the inspector thing. I also know one bank that requires an appraisal every single time they send out a draw. I'm like, that doesn't even make sense.
I've never.
Yeah. So, and you obviously, banks are requiring title bring downs,
Mhm.
which is a pretty substantial process. And as you know, the refis and a lot of the title company, a lot of the transactions have increased over the last 12 months with title companies. They're just backed up, and title drawdowns, title bring downs are not the money makers for title companies. So they're just like, it just gets pushed to the back, and they're like, nah, we'll do it like in a week or so.
We should probably touch on that. That's something that we at WCP do not require. So again, that relates to speeding the process up.
Yeah, absolutely. So that's another reason why we're just faster than the banks.
Yeah. What else do we have?
Yeah,
I
I'm
think
trying.
one is that hard money lenders are riskier.
Yeah,
Again,
risk is a good one.
more expensive, but I I never fully understood what makes our loans riskier than others. Is
Yeah,
it
I
because
think it's just cost. Yeah.
cost?
Yeah, I mean, like there's only several reasons why a loan would be, why you may have more risk with one lender over another. I think it's a good topic to hit on. You should know what you're signing, right? There's a lot of, and part of the reason why hard money lenders get a bad rap is there are some unscrupulous, lenders in the industry, and you just have to watch out for those folks. We're not going to name names, but there's definitely some smaller mom and pop type groups that are just not, having the right business, and trying to take advantage of people. And so always, read your documents. Like, what do your loan docs actually state? Um, and specifically around like maturity dates, ask your lender, what is your policies around maturing? At WCP, we've got a very well-defined process as you get closer to the maturity date that our servicing team handles with you. So we can. It's not going to be the last day of your, when your loan is maturing and then you're getting foreclosed on or something like that. But there are some lenders out there that on the payoff statement, if you get to that point, 5 points or 6 points, and it's highway robbery. And if you don't have a margin in your deal already, yeah.
I feel that's very antiquated.
Yeah. Yeah, exactly.
Where the industry has really has come, steps forward with that.
Yeah. Yeah. Well, that's a good one. Another one that just came to my mind was that hard money lenders don't require docs.
Yep.
Like I have seen a couple folks that are saying no doc loans or no credit check and all this kind of stuff. Those people are private lenders, just privately wealthy individuals that want to lend their money out. The reality is they're not, they're, like it's really tough to build and scale a business based on that type of relationship, because you never know when they have money. What is their servicing like? It's probably just one man or woman, and like they're running the show. Do they have an accounting team? Are they getting you the right payoffs? Are they adding a bunch of fees on there because they want to? Like
They can't do
the
that.
customer service is just not there, and that's so much of it.
My biggest fear with the no doc and like 100% lenders, which we can touch on in a moment, is
Yeah.
that people are what could used to be considered and may still be in that connotation of loan to own, right?
Mm.
Not everyone out there is loan to own, but if people are offering 100% or no doc, if they have to foreclose, they're probably pretty comfortable doing that. If they're willing to take that risk, that much risk of sending a loan out with that value or without any documents.
Yeah, I mean, how do you trust somebody with hundreds of thousands of dollars and not just collect some documents? It's like, we're not talking about anything crazy here, folks. Like, this isn't balance sheet lending where we're like, oh, your income is this and that. Like, I mean, we want to know the general picture of the profile of you as a borrower, but we are asset-based lenders. That's what hard money lenders are at the core. And the 99% of the underwriting and analysis on the deal is what is our LTV and LTC on, on each project? Do we look at a couple other items relating to the borrower profile? Yeah, but the vast majority of it is centered on the deal itself. So, do we have to collect a couple of docs? Yeah, but is it the end of the world? I'm sorry, but if you're if you're so lazy that you can't send some docs, maybe you shouldn't be doing flipping. This is real risk in this business. And if you don't have the organizational structure to be able to do have your docs together and just put it in a folder on your desktop, I'm starting to question,
Personally, when someone's like, I don't want to send anything, it makes me nervous. It's like, what are you hiding that you want $1,000 from me, but you're not willing to involve me? That's a red flag to me personally. And there might be someone out there for you, but I might not be it.
Yeah, exactly. I mean, not every single person is going to be a borrower of ours. We're trying to get people the lowest possible rates. We do have, the ability to do pretty high leverage as well, competitive with the rest of the market. And even still, some people, it's not a fit for everybody. And we get that. We're trying to let borrowers scale on our platform. We've tapped into relationships that allow for cheaper cost of capital, and we're trying to help everybody in the industry. But some people don't want to scale, and some people are just stuck in their way. So it's not going to be a fit for everybody.
Yeah. I mentioned it before, but another myth is that all hard money lenders lend at 100% financing, meaning 100% of the purchase price and 100% of the construction cost. You're just going to walk with all that money. There may be some people out there that do that, but as we mentioned before, my opinion is those people are setting you up to potentially fail, and they're willing to take it back. With where the space has gone, hard money lenders want to see skin in the game, whether that's 10%, 20%, whatever it might be per the deal, or it could even be a piece of collateral from another property. So not all hard money lenders are going to be at 100%, nor do I think they should be. I think that what we have seen since, COVID hit a year ago is those that were offering that high leverage, their clients weren't able to refinance out of the deal when things kind of hit the fan.
Exactly. You got to be thinking about your exit strategies. And then that plays in exactly with this whole question of how much leverage do you get, right? I mean, there's certain things that you really can't control. You can try to solve for them, like having a good contractor, and really interviewing as many as you can. But what if your contractor goes bad? What if your material costs increase? Oh wait, they already have threefold. What if all this stuff happens and you find yourself in a really tough spot, and instead of flipping it, you're like, you know what? I should sit on this property and just rent it out. And my exit strategy needs to be put long-term debt on this, 30-year debt, which we can also help with. But, regardless of whether it's us or not, you need an exit strategy, and 100% financing is not going to get you there. And honestly, you're just over leveraging the deal. Your financing cost, when you're looking at your pro forma, is going to be astronomical, and it's really going to weigh down your deal. So people think they're doing themselves a favor by not bringing any money, but that really becomes just too expensive for the deal, pro forma to handle.
It's really cool as an investor to say, I got 100% financing, and tell all your friends about that. It's kind of like a banner item.
Right.
It hurts you in the long run, especially when things hit the fan.
Yeah, absolutely. And look, there's other ways to get quote unquote 100% financing. Get a partner, raise the money. If it's not your money, that's fine. I mean, in theory, in practice, do we want to have some amount of your own money? Yes, because we want the incentives to be aligned. If you've got no skin in the game, it's much easier for you to walk away than say you've got some of your money in there and you're like, I'm really dedicated to finishing this project out, positive or negative, whatever ends up happening here. So, but you can supplement your own cash with raising equity. So you can kind of get there. It's just not 100% debt, that's just where you kind of go off the rails. So, and it's just way riskier. The lenders that I know that are doing it have a much higher foreclosure rate. You know, like foreclosure rate averages in the industry are generally under 1%. And the groups that I've heard in at least the DMV, we're talking about 25 to 30% of their total book as foreclosures. I mean, that's loan to own, you know. Again, not going to say any names, but it's just like,
and they have to be able to be prepared to build that, right?
yeah, absolutely. They're looking at it as if they're going to be builders, which is scary to me. You know, and another thing, this is a secret a lot of people don't know, but a lot of the lenders, they know each other. And guess what? We see other lenders in the industry that have bad deals that are like, hey, would you buy these notes? And come to us and say, hey, we had this REO, this foreclosure, and we're looking at these things and we're like, what did you lend it at here? Like, this was like 120% LTV. I mean, it doesn't even make sense. You're going to lose hundreds of thousands of dollars. So, you know, I promise you, you know, they're probably not going to do that so often, you know, unless they're forcing taking back good projects as well.
With that foreclosure rate, lenders just can't stick around.
Yeah.
They're out.
Exactly. And so if you're building your whole business and the scalability of your business on this type of lender, you got to understand they're going to go away one day and you're going to be left. What if you've got all your notes with them, like all your loans, and then they call your loans because they go into bankruptcy or, you know, something like that happens. I mean, we just saw it this last summer with COVID. There's a couple lenders that kind of went under a little bit, and you know, what happens to the good borrowers that we're paying on time? Like, are their notes called? I mean, it's just a lot of risk in that.
Yeah, there is. That was really unfortunate to see.
It was.
At the same time, it goes to show for WCP how we're underwriting our deals, that not only protected ourselves, that protected our clients. It goes back to the skin in the game, and by requiring clients to put 10 to 20% down, even if they weren't able to finish the project with WCP, they were able to get long-term debt, even if the project wasn't finished, because they had owned the property and there was enough equity already put in. That is that's what banks are looking for. So when we're asking for this amount of down payment, whatever it is, it's not just because we want to protect ourselves. It is protecting you as well, giving the client multiple exit strategies.
Yeah. What you just said sparked something else for me. You got to ask, as a borrower, what is the structure? What's the financial structure? What's the capital structure of your lender? Like, do they have an actual regulated fund like WCP does? You can go on our website and look at the returns of our, you know, Reg D fund and say, oh, wow, these guys have been performing for years and years and years and giving a great return on money to actual investors, you know. And by the way, anybody listening, if you're an accredited investor, you know, we're open for business. You can, you know, park your money with us and have a really great diversified, you know, put some of your money with us, have it diversified. It's not just in the market. It's spread across you know, a large number of loans. So, you know, our other lenders, how are they structured? You know, are they just...
That relates back to what you were saying earlier. Is it just one wealthy individual that,
yeah,
you know,
exactly,
401k or something, or is it a structure like we have where, you know, we're a direct lender because we have that Reg D fund?
Yep.
So like learning that, I think that those that do have a fund of that nature are going to be a little bit more sophisticated. These are when the docs are required. You're going to have skin in the game, all those things. But also those individuals are going to have a lower foreclosure rate.
Yeah, we have to be fiduciary to our investors.
Yeah.
I mean, it just goes to show, like, we came out of the COVID, you know, market crash and unscathed. I mean, we're here today. We're back. We're better, stronger than ever. And we were fiduciary to our investors throughout. So, you know, if you hear stuff on the street, you know, about a lender and how they're treating their investors, just know that that is a good reflection of how they also treat their borrowers. Yeah.
Absolutely.
Thinking through this again, what's another one? I know there's some confusion around like pre-qual versus like proof of funds.
That's a good
What do you see there as far as myths go?
To be honest, I think that really depends on the lender that you're working with. Someone actually just yesterday asked me, how much am I approved for? Well, we're not a traditional bank where I'm going to say this individual was approved for $1 million or $500,000, because this goes back to what you were stating earlier. We're asset based. Every single deal is individualized for that particular property. So specifically for WCP, we may qualify a person in terms of this is likely the rate you're going to be able to fall into, and this is the leverage that you can get. But we're never going to say this person can not get a loan of X amount of dollars because it's asset based. There are other lenders out there that, based on their experience or credit score, will approve only up to a certain amount. However, that to me doesn't make sense. Why are you going to cap a client based on their experience if they have the liquidity to do a larger deal?
Yeah, exactly. I always say like the fun starts once you have a project. You know, once you have a property address, that's when we can really go deeper on the relationship as you know, a lender and borrower. So that's at the point at which we can, you know, if you're looking for a property and you found one you really like, that's when you can reach out to one of our loan officers and ask for a proof of funds letter to accompany your offer. Right. The pre-qual stuff, it's more traditional business banking. Really, the only time I could see that being relevant is maybe if you had a property that was free and clear, or mostly free and clear, maybe had a little bit of debt, and the value was substantially more the debt you had, and you wanted to get you wanted to do a loan, and we could structure that where, you know, it was there was a large amount of holdback, you know, and you could draw down on that amount. And if it was mostly, if it was pretty large enough, we could do it with accrual interest. So you're not paying until you draw it out. So that's really kind of the only type of like credit line type of scenario I could see, but it's not really a traditional credit line.
For me, the pre-qual situation really is just the initial phone call. We're learning about each other. You know, what is your estimated credit score, experience? How much liquidity are you willing to put into a deal? That way I can back in to say, this is probably the purchase price you should be looking for. But I always tell everyone that's just starting out, just send me projects that you're looking at. For us, all we need to get started is the address, purchase price, and estimated construction costs. And we can get some terms out there pretty quickly. I know there's some other lenders out there. Actually, this is something we can touch on. Yeah. Underwriting fees. There are other lenders out there that will charge you per property that you send to them, regardless of if you have it under contract or not. WCP does not charge that. You can send it our way. We want to send you over the terms so that you understand what it is that we're looking at. So when you actually do find a project that you're going to purchase, you're already, for lack of a better term, conditioned to know what the loan structure is going to look like.
Yeah, absolutely. I mean, the cool part about this is obviously we have to know a little bit about the borrower profile, right? To be able to understand how that's going to drive rates and cost. But this is a lot of this is formulaic. And so we can provide you with the tools of those formulas. And while you're out there, you don't even need our help. Like, you know, if your loan officer is doing the right thing, they're giving you the knowledge. They're giving you the tools to then go and sorry about that. Go and know what even the loan size is, right? Like the only pre-qual that I can really think of is like asking, you know, how much liquid cash do you have and do you want to put in a deal? And then we can back into the exact loan size that you would qualify for, which is so cool. Yeah. So I do that sometimes when it's more so when somebody doesn't have quite as much. They're just starting off. They're like, look, I got 25 grand or I've got 50 grand. I'm like, well, that gets you a $120,000 loan, you know? Go check out Baltimore City, or like go check out PG, or wherever you can get in there.
I think that's a huge advantage. And if the lender that you're not working with can't back into it and tell you which properties to be targeting,
Yeah.
likely not working with the right lender, because they should already know loan sizes. If you only have a set amount of liquidity to use, I think you use 50.
Mm-hmm.
Not going to be looking at 500K purchase prices. Like let's target you. Let's get you into the deal at purchase prices. So ask that question. Make sure that you're telling people how much you're willing to put into a deal. We never want to have everyone use all of their savings.
Right. No.
That's a big thing.
Yeah.
Ask people what you're willing to put into it, so that we can find the correct purchase prices for you.
Yeah, absolutely. I mean, it's human nature. Two things come to mind. It's human nature, right? I would say one of the biggest reasons people fail with finances and with business ventures is because they're not focused, right? They're all over the place, and we know those people. Like, there are people that are sending us, tons of different deals. This $1 million deal, and then a $200,000 deal, and it's like, figure out, like, sit down and map out what is your business, like where are you going to start targeting, and then maybe there's a growth plan. But if you're all over the place and you're spending and wasting all your time looking for $1 million deals, and you could only really do a $200,000 deal, you're just wasting your time. That could have been time that you were building your business and making money.
Absolutely.
And instead, you're trying to do something right away. There's a lot to be said about growing slowly, being calculated about it, and making the right steps and protecting yourself. I mean, there's already so much inherent risk. Why in this business? Why do you have to add more?
Yeah, I think that something that we do very well at WCP is with the new investors.
Right.
We are able to walk them through the process. But one of the things that we're actually able to do is we end up making these clients bankable.
Yes, that's literally our goal. Like, our goal is like, please leave us.
Yeah.
Eventually, like, we're gonna, we're gonna help you get to where you need to go. And hopefully that is, you've scaled up a business, you're bankable now, you don't need us, and maybe you don't forget about your friends, and you call every once in a while, but otherwise you're on to greener pastures. So yeah, that's a really good point. What else? What can hard money not be used for? Like, we get a lot of, obviously every lender spends some marketing spend, online, SEO, all that kind of stuff. We get a good number of people that reach out, and they're like, hey, I need to pay my credit card bill off, or like, I want to buy, title liens, or
I think there's two answers to that question. One is particular to us and some of the more refined hard money lenders. We can't do anything that's consumer based. We will get into that in a whole other podcast. So anything that's planned to be owner occupied, that's not something WCP can do, nor any of our larger competitors. If there's a hard money lender that's doing that, it's likely a private person, just because of regulatory issues. And the other thing is, title liens. We heard someone the other day wanted to buy a snowmobile with a loan from us. We're only going to be real estate asset backed. Most of the people that you're dealing with our size, or again, in our refined space, are only focused on real estate. They're not going to be helping you buy watches. I know years ago, someone asked to buy I think it was a restaurant boat, was one of the ones.
A restaurant boat. That's kind of cool.
Yeah, that was out in California.
I remember that one. Yeah, I remember that one.
A llama farm. Although that's
peach farm.
Maybe we're not doing that one. So anything residentially real estate backed, not saying that we can't do mixed use or things of that nature, or other harmonies that can't do that. Most a resi backed asset.
Yeah, I mean, look, we love the net operating income analysis, and we will look at that. We'll entertain that. We want to know what income is the property throwing off, if it's tenanted, or if there's business cash flow coming from it. But yeah, exactly. Are the restaurants there? Whatever. But at the end of the day, we still want to know, what is the fire sale? Like, that's always the question. Like, what's the fire sale cost of this business? Of this property. If we went out on a street corner and said, raised our hand and just yelled, "Hey, we're selling this building," like, who's buying it and for how much? What are we going to get from that? So that's always kind of in the back of a lender's mind. Because what if it goes away? What if COVID happens? Oh wait, it already did. And the business goes out of, goes under, and there's no income, or your tenants stop paying because there's a global pandemic. So you have to, that's a part of the risk analysis you have to do as a lender. But yeah, great point. If you want a snowmobile that costs $4,000, maybe you shouldn't buy that snowmobile, and you need to, maybe that's just, some of this is just financial literacy, I think, but, to each his own. But yeah, consumer debt, to go back to that, the really, to drive that point home, there's strict regulatory bodies in place, legislation, in place, especially after 2008, to really define the commercial lending and the residential lending spaces. And there's real value in having done this, and in protecting a large number of people in the country. I mean, what the regulatory groups want to protect against is commercial lenders, investment type lenders like ourselves in this space, that are giving loans out, to people that are not institutionally educated, right? That don't understand investments, and that don't possibly understand the ramifications of taking on this kind of loan. That may be a higher rate than a 3% mortgage, wherever mortgage rates are these days, right? So there's true value in having that regulation in place. And these regulatory bodies have very massive fines that we can't mess with. So can some small, privately wealthy private lender, are they willing to take the risk? This law applies to them as well, but are they maybe only doing 5 or 10 loans a year, and they're willing to take that risk, stomach that risk?
Not going to be seen.
Yeah. I wouldn't. I mean, I would be terrified. In fact, if you're the borrower, and your lender is doing that, and they get caught, that could be a career-ending fine. We're talking millions. So, do they get hit with a fine and then file bankruptcy, and then your loans are trapped in the bankruptcy estate? So I promise you, it's not going to be pretty.
Yeah, true. I didn't even think to relate those two items.
Yeah, I mean, what if we're out there doing consumer loans and we get hit with a bunch of fines, and that tanks the company? I can promise you, all of the WCP bars out there are happy that we're not doing consumer loans.
Yes, absolutely.
Yeah. Oh yeah. Cool. Well, that's really all I had. There's a lot of crazy myths, as you heard. We hear stuff all the time, and it's interesting. I think that these myths will continue to get dispelled over time as the industry becomes even more institutional. The Wall Street groups, the massive billion-dollar funds, are chasing the space. We've seen a transformation since 2015 to the present, and it's only going to accelerate more as a lot of money is chasing good returns. And with the market, at all-time highs, and a lot of concern over, is it a bubble? And the more you hear that kind of talk, people are going to say, where can I find good yields on, income producing property or just hard assets? Especially with all this money that's just been pumped into the system, there is going to be inflation concerns. And what's the best way to protect against inflation? Buy hard assets, buy real estate, buy, precious metals, that kind of stuff, as a hedge against inflation. So you're going to see more and more of that, and really the industry continue to evolve. You're going to see lower rates. you're probably going to see more docs as a result of that. But hey, I would gladly trade a couple more docs for a couple less points. So it's just the nature of it.
Yeah. There is a regulatory body out there. I believe it's, you'll know it once I say it. It's the American Private Lender. I forgot the last word. Yes, correct. Yep.
Yeah.
And they're out there creating regulatory rules for all the lenders in our space to protect the consumers and the clients. So
yeah, they're a, you know, just like every industry has their kind of a lobbying group that is out there pushing for the you know, the proper legal framework for the industry. And so, yeah, I mean, it's coming along. It's not a massive, it's not a massive space, but there's a massive amount of money chasing it. And, you've seen the space really kind of be just really kind of get a little bit smaller, because you got a lot of very mega regional lenders that are kind of growing up in the space. So the mom and pops are definitely going away. They're always going to be there to some degree, and private lenders are always going to be there. They fill a need as well, but I do think that slowly goes away over time. So yeah, a lot of cool stuff in the industry. And this was really fun. This is a little bit of a lighter topic than what we've been doing. It's kind of a little more serious, more complicated topics, but it's nice to kind of mix it up with you and talk about some of these crazy myths and scenarios. We'll be back with you all for Minicast number 8 in a week or two. So stay tuned for that. We really appreciate you tuning in and listening to us. It's been fun.
Yeah, absolutely. Appreciate it.
Yep. All right. See ya.